Definition of unit trust. Unit trust is an unincorporated mutual fund structure that allow fund to hold asset and provide profit that goes straight to individual unit owner instead of reinvesting them back into the fund. Mutual fund are investments that are made up of pooled money from investors which hold various securities such as bonds and equities. However, a unit trust differs from a mutual fund in that a unit trust is established under a trust deed, and the investor is effectively the beneficiary of the trust.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shamimi binti Azman. My metric number is 2182888. Today, I want to explain about the types of the unit trust. There are several types of unit trust that investor can choose from depending on their investment goals and risk tolerance. Here are some of the most common types of unit trust. Okay, the first types of funds. First, equity funds. Equity funds invest in stock and share of company listed on the stock exchange. These funds are ideal for investors who are seeking long-term capital growth and are willing to accept a highest level of risk. Second, fixed income funds, such as bond funds. Bond funds invest in fixed income securities such as government, bonds, and other debt security. These funds are ideal for investors who are seeking a regular income stream and are willing to accept a lower level of risk. Okay, the three types of funds. Money market. Money market fund invest in short-term debt securities such as treasury bill, commercial paper, and certificate of deposit. These funds are ideal for investors who are seeking low-risk investment with a short-term investment horizon. 4. Balance fund. Balance funds invest in a mix of equity and fixed income security. These funds are ideal for investors who are seeking a balanced portfolio with both capital growth and income generation. The last types of fund is index fund. Index fund aim to replicate the performance of a stock market index such as the AFS2043 and S&P 500. These funds are ideal for investors who prefer passive investing and do not want to take on active fund management fees.
Difference between exchange traded fund (ETF) and unit trust. ETF are priced as they are traded on a stock exchange throughout the day. You can instruct your stockbroker to buy or sell at any time while the market is open. But unit trusts are priced once a day only, and you will only be told the net asset value at which you have invested the day after you invest.
Okay, next, here are some of the common issues that can arise in unit trust. First, about the market risk. The value of a unit trust can be affected by fluctuation in the financial market. Change in interest rates, global political events, and economic conditions can all impact the value of the asset held by the unit trust. Second, management risk. The performance of a unit trust is dependent on the skill and decision of the fund manager. Poor investment decision or ineffective management can result in poor returns for investors. Third risk is liquidity risk. Unit trusts can face liquidity issue if there are too many investors looking to sell their units at the same time. This can result in delayed redemption or the unit trust being unable to meet redemption requests. 4. Fees and expense. Unit trusts can have high fees and expense that can eat into the return generated by the funds. Investors should be aware of all fees and expenses associated with a unit trust before investing. 5. Lack of control. Investors in unit trusts have little control over the asset held by the funds. This means that they cannot choose the individual investment made by the fund and must rely on the fund manager to make investment decisions on their behalf. Okay, the next risk is a lack of transparency. Some unit trusts may not be transparent about the underlying asset held by the fund, which can make it difficult for investors to assess the level of risk involved. The last risk is taxation. Unit trusts can be subject to different tax rules depending on the jurisdiction in which they are held. Investors should consult a tax professional to understand the tax implication of investing in a unit trust.
Assalamualaikum and hi, my name is Fatun Zafira binti Zula and my metric number is A21833251. I want to share about definition of real estate investment trust REIT. A real estate investment trust REIT is a company that owns, operates or finance income generating real estate or producing properties. REIT generate a steady income stream for investors but offer little in the way of capital appreciation. REIT is strictly governed by regulator and highly transparent due to the scholar obligation. Most REIT are publicly traded like stock, which make them highly liquid, unlike physical real estate investment. REIT invest in most real estate property types, including apartment building, cell tower, data center, hotel, medical facility, office, retail center, and warehouse. And this is the REIT structure.
The next part is task and the function of parties in a REIT. The first one is investor. The primary function of investors in a REIT is to provide capital to the REIT in return for ownership in the form of shares. They receive regular dividends and capital appreciation from the REIT's real estate holdings. Second one is the board of directors. The board of directors is responsible for setting the REIT's strategic objective, overseeing management, and ensuring that the REIT operates in the best interest of shareholders. The third one is executive officer. The executive officer are responsible for executing the REIT's strategic objective, managing the REIT real estate assets, and maximizing shareholders' value. Moreover, the task and the function of parties in a REIT is property manager. Property managers are responsible for the day-to-day management of REIT's real estate assets, including leasing, maintenance, repairs, and tenant relations. Their goal is to maximize the income and value of the properties. Last but not least is investment advisor. Investment advisor is provide advice to the REIT's management teams and board of directors on investment lives, strategies, asset allocation, and market condition. Their goal is to maximize the return on the REIT's investment and minimize the risk.
Okay, I'm gonna explain about the similarities and differences of conventional REITs. First, for similarities, real estate investments. Conventional REITs invest in real estate properties like commercial buildings, apartments, and retail spaces. Next is dividend distribution. Conventional REITs distribute a significant portion of their earnings to shareholders as dividends, providing investors with regular income. The third one is diversification. Conventional REITs offer diversification by investing in a variety of properties across different sectors and locations. And finally, accessible to individual investors. Conventional REITs allow individual investors to participate in real estate investments without needing a lot of money. Investors can buy and sell shares of conventional REITs. Next is about differences in conventional REITs. The first one are different focus. Other REITs may focus on something else, not just regular properties like conventional REITs. For example, some focus on lending money for mortgages. Second, where money comes from. Conventional REITs make money from renting properties, while other REITs have additional ways of earning. The third one is different roles. Each type of REIT follows its own set of rules based on what they invest in and how they operate. And finally, different risk. Different REITs have different level of risk. Some are more affected by interest rate changes, while others depend on property values or how many spaces are rented.
I will present about the definition of a deed trust. Deed trust is a legal document that commonly used in real estate that represent an agreement between three parties, which are borrower, lender, and also trustee to have a property. However, the trust is a non-document outlines the terms and conditions of a loan used to purchase a property. We can see the trusts are recorded in public record, just like a mortgage. Besides that, the trust gives the lender the right to foreclose on the property if the borrower defaults on the loans.
The characteristic of trust deed. First, security entrustment. Trust deeds are used as security entrustment for mortgage loans, providing the lender with a lien against the property as collateral for the loan. 2. Three-party agreement. Trust deeds involve three parties: the borrower, the lender, and the trustee. The borrower is the property owner who is obtaining the loan. The lender is institution or individual providing the funds, and the trustee is the neutral third party that holds the title to the property as security the loan. 3. Non-judicial foreclosure. Trust deeds are typically used instead with non-judicial foreclosure laws, which means that if the borrower defaults on the loan, the lender can foreclose on the property without going through the court system. And the next, transferable. Trust deeds are transferable, which means that the lender can sell or assign the loan to another party without affecting the terms of the trust deeds. And 4 and 5, recorded in public records. Trust deeds are recorded in public records, which means that anyone can access them and review the terms of loan. And lastly, governing law. Trust deeds are governed by state law, which can vary from state to state.
Alright, the last one, we will back to differentiate between trust deed and warranty deed. A trust deed is a legal document used in real estate transactions that establish a trust relationship between three parties, which is the borrower, the lender, and a trustee. It is commonly used in a mortgage transactions to secure a loan. A warranty deed is a legal document used to transfer ownership of real estate from one party, the grantor, to another, the grantee. It provides certain insurance to the grantee regarding the title and ownership of the property. Here are the key of characteristics of a trust deed. First, parties involved. Parties involved, which is a trust deed, involve three parties, which is the borrower, also known as the trustor and grantor, the lender, also known as the beneficiary, and a trustee. Second, collateral. The trust deed is used to secure the loan by using the property being financed as collateral. Third, title ownership. In a trust deed, legal title to the property is transferred to the trustee, who holds it on behalf of the lender. And last one is foreclosure process. If the borrower defaults on the loan, the lender can initiate foreclosure proceedings. The trustee acting on behalf of the lender has the power to sell the property to repay the outstanding debt. Here are the key characteristics of a warranty deed. First, transfer of ownership. A warranty deed transfers full ownership rights and interest in the property from the grantor to the grantee. Second, legal protection. The grantee receives legal protection through the warranties provided in the deeds. Third, title warranty. The grantor provides insurance or warranties to the grantee regarding to property titles. And the last one is title insurance. In addition to the warranties, it is common for the grantee to obtain title insurance to further protect against any unforeseen title issues or claims that may arise in the future. So, it is important to note that the specific requirements and terms for trust deeds and warranty deeds may vary by jurisdiction. It is recommended to consult with a legal professional or real estate expert who is familiar with the law and practice in your specific area. So, that's all from me, and thank you.